All right, let's talk about something you hear in the news pretty much every single day. The Dow. We hear the Dow is up, the Dow is down, but what in the world is it? And honestly, after more than 100 years, why should you still care?
I mean, you see headlines just like this one constantly, right? The market is buzzing, stocks are moving, and the Dow is always right there, front and center, almost like it's the pulse of the entire U.S. economy.
And that's the real question. It seems so simple on the surface, but the answer? Well, it's actually a lot more interesting and maybe a little bit weirder than you'd think. So let's pull back the curtain on one of the most famous numbers in finance.
Okay, so to really get this, we've got to start with the absolute basics. What is the Dow? Well, when you hear that name, what people are actually saying is its full, formal name, the Dow Jones Industrial Average.
The easiest way to think about it is like a super exclusive club. It's not the entire stock market, not by a long shot. It's a hand-picked list of just 30 massive, influential American companies. You know, the blue chips, household names that are supposed to give us a quick, at-a-glance snapshot of how the big players in the economy are doing.
And this thing has been around forever. We're talking way back to 1896, created by Charles Dow of the Wall Street Journal. Back then, it was just 12 companies, mostly industrial giants like railroads. By 1928, it grew to the 30 companies we know today. And even though that industrial name stuck around, the index itself has totally evolved to include everything from tech to healthcare.
And that really gets to the core of it. Its entire purpose, its reason for being, is to act as a barometer for the U.S. stock market. For over 130 years, its daily ups and downs have been telling a story about the health of American business. But, and this is a big but, here's where things get a little strange. And for a lot of people in finance, it's pretty controversial. See, to really understand the Dow, you have to know how it's calculated, because not all indexes are built the same way. Now, almost every other major index you hear about, like the S&P 500, is market cap weighted. That's just a fancy way of saying that the bigger the company's total value, the more it moves the index. Makes sense, right? But the Dow, it does things differently. It's price-weighted. All that matters is the price of a single share of stock.
And this is exactly where the criticism comes in. A company's stock price can be kinda arbitrary, you know? They can split their stock anytime they want to lower the price, but that doesn't change the company's actual value. And because of that, this method can sometimes paint a really distorted picture. Just look at this. It creates this bizarre scenario where a company with a $500 stock price has more influence on the Dow's movement than a company that is 10 times bigger in total value, just because that bigger company happens to have a $50 stock price. It's a really old-school way of doing things, and it has huge implications.
So who exactly gets to be in this exclusive, kind of quirky club? Well, the 30 companies in the Dow are literally handpicked by a committee from the Wall Street Journal. The idea is to choose companies that represent a wide swath of the American economy.
And even with that industrial name, you might be surprised at what really drives the index these days. Take a look at this. The financial sector makes up more than a quarter of the Dow. That gives banks and investment firms a huge voice in this so-called market barometer.
And right here, this is that price-weighting quirk in action. Just because Goldman Sachs has a really high stock price, it alone accounts for over 10% of the Dow's entire movement. Now, compare that to a corporate giant like Microsoft, which has about half that influence, simply because its per-share price is lower. Wild, right? Okay, so you've definitely heard people talk about investing in the Dow, but how do you actually do that? It's not like you can just buy the index itself. Instead, you can buy a fund that's designed to perfectly track it. The most common way people do this is with an exchange-traded fund, or ETF. And for the Dow, the big one is the SPDR Dow Jones ETF. You'll know it by its ticker symbol, DIA. It's often nicknamed Diamonds, and its whole job is to own all 30 Dow stocks in the exact same proportions as the index.
Now, any ETF is going to charge a tiny annual fee to manage everything, and that's called the expense ratio. For DIA, that fee is just 0.16%. To put that into perspective for you, if you invested $10,000, you'd pay about $16 a year. That is considered super low cost for getting to own a piece of all 30 of these blue chip companies.
And it is incredibly popular. I mean, look at that number. Investors have put over $41 billion into this one fund. That just shows you how many people see this ETF as their main way to invest in the story of America's biggest, most established companies. So what about the results? Well, since it launched back in 1998, the fund has given investors an average return of just over 9% per year.
That's a pretty solid track record of steady, long-term growth, basically mirroring the Dow itself.
Okay, so this brings us to the big question, the one everyone debates. In a world completely driven by technology and fast-moving innovation, does this 130-year-old index still matter?
When you look at the numbers, especially since the start of the modern tech era around 2000, a really clear story starts to form. The Nasdaq, which is just packed with tech innovators, has absolutely exploded. The broader S&P 500 has also done incredibly well. The Dow, it's had impressive growth for sure, but it just hasn't kept up with the indexes that have a bigger slice of that tech revolution.
So here's the takeaway. The Dow tends to be a smoother ride, it's less volatile, its blue-chip stocks often hold their ground better when the market gets shaky. But that stability, combined with its weird price weighting and narrow focus, means it has missed out on some of the huge gains from the tech sector that have really defined our economy lately.
Which brings us right back to that big question. There's no doubt the Dow is an icon. It's historic, it's simple to understand, and the media absolutely loves it. But in an economy that's now being built on artificial intelligence, software, and constant innovation, is an index of just 30 companies weighted by their stock price really the vital sign we should all be watching? That's the question to think about. Thanks for tuning in.